Is the price-to-earnings ratio a reliable tool for stock valuation? Many investors swear by it, but according to financial expert Michael Mauboussin, relying solely on the PE ratio can be a significant mistake. Let's start with the basics. What exactly is the PE ratio, and why is it so commonly used? The PE ratio is simply a company's share price divided by its earnings per share. It's often used to determine if a stock is overvalued or undervalued compared to its peers or its own historical performance. However, Michael Mauboussin, a renowned investment strategist, argues that this popular metric can be highly misleading. He emphasizes that focusing solely on the PE ratio can lead investors astray, potentially resulting in poor investment decisions. One of the primary issues Mauboussin highlights is the PE ratio's inherent short-term focus. It tends to provide a snapshot rather than a comprehensive view of a company's true value. The PE ratio reflects current earnings, which are backward-looking. It doesn't adequately capture a company's future cash flows, which are the real drivers of long-term value. This can be a major disconnect for growth-oriented investors. Mauboussin champions a long-term perspective, stressing that a company's true worth lies in its ability to generate cash over many years, not just in its most recent earnings report. Another significant flaw Mauboussin identifies is the PE ratio's inability to account for the quality of earnings. Not all earnings are created equal. The PE ratio doesn't differentiate between earnings derived from sustainable high-quality business operations and those influenced by aggressive accounting practices or one-time events. One-time events, such as asset sales or tax benefits, can artificially inflate earnings, making a PE ratio seem more attractive than it truly is. Conversely, conservative accounting might depress earnings, making a healthy company appear less appealing. Furthermore, the PE ratio often muddles growth expectations with current value, making it difficult to assess a company's future prospects accurately. The PE ratio doesn't explicitly separate the value attributed to current earnings from the value investors are paying for future growth. This can create confusion, especially when evaluating companies with high growth potential. For high-growth companies, a high PE ratio might be justified by their rapid expansion and future earnings power. However, simply looking at the number without considering growth prospects can lead to misjudging such companies as overpriced. So, if the PE ratio is flawed, what does Michael Mauboussin suggest as a more robust alternative for stock valuation? Mauboussin is a strong advocate for discounted cash flow, or DCF, analysis. This method focuses on projecting a company's future free cash flows and discounting them back to their present value, providing a more accurate measure of intrinsic value. Beyond just numbers, Mauboussin stresses the importance of qualitative factors, such as understanding a company's competitive advantage and its economic moat. A strong moat protects a company's profits and market share, leading to more predictable and sustainable cash flows. In conclusion, while the PE ratio is a widely used metric, its limitations can lead to significant misjudgments in stock valuation. Remember, the PE ratio often provides a short-term view, overlooks the quality of earnings, and can be misleading regarding growth expectations. By adopting a more robust valuation approach, like discounted cash flow analysis and considering qualitative factors, investors can make more informed and ultimately more successful investment decisions. Thank you for watching.